Welcome back. This year, the New York Stock Exchange named its first woman president in the exchange's 226-year history. Stacey Cunningham started as an intern at the NYSE back in 1994, but quickly became one of the few women to work as a trader, a market maker on the floor of the exchange. In 2015, she became the chief operating officer, and after playing a key role in modernizing the exchange's trading operations, she was named the NYSE's first female president in May of this year. This week, I visited her at my old stomping ground, the New York Stock Exchange. I spoke with her on a wide range of subjects, including her take on this monster sell-off this week.
The market's been in a pretty extended period of low volatility and lower volumes relative to yesterday. So it was, those point moves are much bigger considering the strength the market has had over time. But on a percentage basis, they're not so significant. It's not even a top 20 market drop.
I realized that this move that we saw this week was small in terms of a percentage of big moves. But still, there's this worry. How's the sentiment down here?
There is. I think the sentiment is not too dissimilar from what it was back in February. So we saw a lot of volatility in early February. We saw the market sell off in a more meaningful way than it had. But very quickly, there was a recovery, and we saw the market continue to trend up throughout the year. It feels a little bit the same, and yesterday felt much like those days back in February, where there is some concern and a little bit of anxiety, but also a hope that the underlying economy is still strong, and that's something that we'll get through. The market tends to correct, and then recover pretty quickly.
What are you seeing in terms of investor flows right now?
Well, I think we're seeing the market react to some of the news that's the global news that's out there. Obviously, the Chinese stocks overnight suffered as well, and so you're seeing some of that shift into places that are a little more secure. So yesterday, the stocks that did a little bit better were utilities and things like that, where there was a little bit more comfort. Overall, though, we still have had a pretty good year, even in the IPO world. So I think the market's going to react to this and then move on.
Let's talk about the IPO story and what you're expecting. It's been a slow couple of years, actually, when you look at new deals coming to market. What's the book look like going forward in the coming year? Are you expecting the IPO volume to pick up?
Yeah, it's been a slow couple of years, but on a trend upwards. So in 2016, we definitely saw a slowdown in the IPO market. 2017, it recovered. And already in 2018, we've exceeded the amount of proceeds raised over 2017. So we're seeing a much better year to date so far. We're on target to outpace 2014. And so that's really, I think, a positive sign in the IPO market. We've seen over 50 deals come to market, raising over $26 billion. So I think there are a lot of good stories in the IPO world.
Yeah, what's most exciting that you're expecting in the year ahead that you can talk to us about?
Well, I think there have been already a number of tech companies that have come to market, and we have a few that are scheduled for the rest of the year. The pipeline is really strong, and there are a lot of companies that are out there. I think they'll be watching the markets pretty closely now to make sure that it's still an environment that's the best time to come public. But we still have a very strong pipeline coming into Q4.
We talk about the pipeline in such a generic way. Let's dig deeper and really explain what goes on in terms of these IPOs, why it's important. This is raising capital for companies to actually prosper and do well, and smaller companies becoming bigger companies. Tell us about it.
And the reach is so much broader than that. When we look at our core mission here at the New York Stock Exchange is to help great companies raise money so they can go out and change the world. That's a good thing. And at the same time, they're providing opportunities for investors to share in that success.
Next week, the Securities and Exchange Commission is going to hold this roundtable on market data and this SIP roundtable, which is Securities Information Processor. What are you expecting in terms of this roundtable looking at market data, and how much is that going to cost you? Is that going to raise fees for the New York Stock Exchange?
No, I think what's important to understand is that the equity market structure has shifted a lot over the past 10 years, and a lot of that's been driven by changes in technology and changes in the regulatory landscape. The beneficiary of those changes has been the end investor. So their costs have come down dramatically. So the modernization of the markets has really helped the investor community. What it's done, though, at the same time is created more fragmentation in the market and some challenges for market professionals. So some of the issues that are debated that you mentioned, things like market data and the SIP processor, which is the mechanism for everyone to see what the public quote is out in the market across all exchanges, those create a little bit more complexity. And there's a desire to simplify some of that, but that really impacts the Wall Street firms. That's not a Main Street problem. And so I think it's important to understand when people read about some of the things debated in the equity markets today, the end investor has it better. Main Street has it better than they ever have had it before. But there's some negotiating going on in Wall Street.
Market data has been critical for investors to empower themselves in terms of investing on their own and not paying incredible fees for themselves to the broker-dealer community. Tell us about the market data and how you've changed data, how you've generated more data for investors.
Right. The value of data has changed dramatically over the past decade. As trading has been fragmented across lots of venues, you need to stitch the market back together. So even professionals are trying to figure out what is the value, how is price discovery unfolding, so that you know as an end investor, you can go log into any of your online trading accounts and see a real-time price for each individual security that's traded without spending a dime. So that's a good result.
Let's talk more about fees for a moment, because the last time we spoke, we were in the studio. We were talking about the Securities and Exchange Commission's new transaction fee pilot.
Right.
You were going to Washington to speak with some influencers, and you were going to try to get them to understand that it's putting the New York Stock Exchange at a disadvantage versus Wall Street, some of the other big firms.
Yeah, and more importantly, it's putting the companies listed on the New York Stock Exchange and their investors at a disadvantage, and that's a concern for us. So we want to make sure that we've lobbied for them and made their positions clear. Many of those public companies have written letters to the SEC asking not to be included in this pilot. They don't want to be at a disadvantage versus their competitors. There are already so many challenges that they're competing on, so many different vectors they're competing on with their own peers. They don't want to add one more. And so we've read through all the comment letters. It's been a very long process of where the SEC has asked for comments from the industry, both companies, investors, institutions, and intermediaries. And we looked through all of those, and we felt like there was a compromise that could be met. So we just submitted last week a letter asking the SEC to consider an alternative pilot that would benefit, achieve a lot of the goals that they're looking to achieve with the transaction fee pilot, which is to bring costs down, but at the same time not to disadvantage the companies that are listed on these markets.
How does this new compromise that you put forth, how is it resonating, and when are you going to get some information from them in terms of what they think of it?
Well, in our conversations with issuers or with investors and with a lot of the sell-side broker-dealers that are part of this conversation as well, they've had a very positive reaction to our proposal, because it does create a bit of a compromise that says, let's bring fees down, but let's keep all of the other fees steady so that we can really see what the impact is. But we don't want to hurt spreads. So we don't want that public quote to widen out, because that means investors are getting worse prices. And so that's one of our primary focuses, is to make sure that at the end of the day, any changes we make don't end up having a negative impact on issuers and investors.
We're in this spat with China, and for a long time it was really Chinese companies coming to the New York Stock Exchange as a major growth opportunity for New York and for the U.S. Certainly the New York Stock Exchange has a lot of Chinese companies trading here. Have you heard any ideas out there to put a limit on the number of Chinese companies that can come public here because we want to retaliate for China's bad behavior?
I haven't heard that specifically. If you look at this year to date, about 33% of our proceeds, IPO proceeds, have been raised outside of the U.S. From companies that are based outside of the U.S., and China's been leading the way on that. So we're still a very welcoming in place for China to come raise money in the U.S. I think it's an area that's closely watched.